In this video, we will discuss trade credit. Trade credit is a major source of financing for small retail businesses. The way it works, for example, I had a friend that owned a Radio Shack. His supplier would be the parent Radio Shack. So the way trade credit works is the supplier, in this case the parent Radio Shack, sends goods to the small business at no cost. The small businesses keeps those products in their store until they sell them. Then the business sells the products to a customer. The customer pays for the product, and the small business then uses the money that the customer pays for the product to pay the supplier and pay off the trade credit. This, of course, doesn't have to be a Radio Shack. It could be any sort of small business, a auto parts store, a lumber yard, a plumbing supply business, etc. Most small businesses, in this example 60%, utilize trade credit. They also, of course, have other ways of financing, whether borrowing from a bank on a regular basis or using a line of credit where they can borrow when they need to, or something as simple as a credit card. Trade credit does have disadvantages. It tends to be quite expensive, therefore it is not necessarily the best way for a small business to finance itself, but it is convenient and it could be cheap if they pay it off quick enough, and many small businesses, of course, don't have good enough finances to get low interest bank loans. The way interest rates on trade credit are quoted are somewhat unusual. We will use the example here of a company called Chambers, and we say assume that its trade credit terms are 410, net 45, and Chambers pays on day 30. So what this means is if Chambers pays within the first 10 days, it gets a 4% discount on the quoted price of a product. So this is similar to if you have a credit card, if you pay it off within 30 days, you don't pay any interest. Well, if they don't pay it off within 10 days, they pay an interest, but the interest isn't exactly 4%. It's higher than that because this is quoted as a discount. So the interest is actually 4% of 96% of the quoted price. And that interest is paid not over a 30-day time period like with a credit card, but over the time period, in this case, they pay on 30 days. The first 10 days are free, so it's an interest rate over the time period of 30 minus 10 are 20 days. That means they would be better off either paying within the first 10 days or waiting till day 45. If they pay within the first 10 days, they effectively pay no interest, they get the 4% discount. If they wait until day 45, then they get a lower interest rate than if they paid on day 30. We will calculate the interest rate that Chambers pays on trade credit in two different ways. The first will be APR, or the annual percentage rate. The annual percentage rate does not take into account compounding. The other way is the EAR, or effective annual rate, which does take into account compounding, or the interest on interest that is paid. To calculate APR, we first need to know the interest rate per period, which in this example is going to be 4 divided by 96, or 100 minus 4, which is the interest rate per period, and then we need to know the number of periods per year. We are assuming a 365-day year, and the number of periods are they pay on day 30, the first 10 days are free, so each period is 20 days. The total number of periods is 365 divided by 20, are 18.25 days. This gives a very high interest rate of 76.04%. Again, the company could have lowered this interest rate by waiting till day 45 or paid no interest by paying within day 10. The second method, EAR, takes 1 plus the interest rate to the number of periods minus 1, therefore taking into account the interest on interest that is paid. In this example, this is 1 plus 4 divided by 96, taken to the power of 18.25 minus 1 are 110.6%. Again, the EAR is higher than the APR because it takes into account interest on interest. Both of these numbers are very high. Trade credit is commonly a very expensive way for businesses to finance. Again, the business could have done this much cheaper by paying within the first 10 days or at least waiting till day 45 instead of paying on day 30. I thank you for watching this video.